Mr. Vasudevan, good morning. This is Neeraj here.
Yeah,
congratulations on a stellar listing. Your first message really, before I ask my questions, the market has shown its faith in the story that you've provided. What can you guide about the near term for Equitas Holdings going ahead?
Thank you, Neeraj. Thank you, investors, for showing the confidence in the company. Thank you for taking the issue at 17 times oversubscription. From the beginning, we have been very focused on governance, and we have also been extremely focused in terms of our social initiatives, which helps our customers and the community from where they come on a holistic basis. And of course, financial performance is something that anyway we always have to be focused. And I am very happy to note that investors are willing to support companies with business models which not just focuses on financials but also focuses on a lot of relevant social initiatives.
Yeah, right. Mr. Vasudevan, congratulations on this listing. That, of course, is the broad outlook for the business. And given the diversified business model that you have, I mean, you're present in microfinance, vehicle finance, housing finance. Where do you see the most significant trigger for growth? What will lend support in terms of the next leap of growth that your company would take?
See, Equitas, we have Equitas Microfinance, which contributes 53% of the total AUM. Equitas Vehicle Finance contributes about 25%, and our Equitas SME contributes about 17%. Last 4 years, we have been having a growth, a CAGR growth of around 55%. We do operate in segments of society which is largely unserved by the formal financial system, and so there is always a large demand which is still not being serviced effectively by the financial services systems. We do hope that we will be continuously able to offer our services to these segments. Of course, in terms of future guidance on growth rates, etc., we won't be able to share at this point in time, but we do hope to be able to service a large number of customers going forward.
You'll still be at some liberty to be able to talk about some numbers. So let me ask you, you may not be able to give me exact numbers, Mr. Vasudevan, but the street believes that your AUM CAGR over the next 3 or 4 years could be northwards of 30-35%. Actually, the numbers are even higher than that, but I'm being a bit conservative. Do you think such kind of AUM growth is possible?
See, from a market potential and market demand perspective, definitely the demand is very high. The number of the percentage of the market demand which is being serviced across all the products that we operate in, be it microfinance, used commercial, micro SME and affordable housing. Across the segments, the percentage of market demand which is being serviced is definitely very low today in the segments that we operate in, which is basically the informal and low income segment that we operate. So the demand definitely is there, the market potential exists, and if you look at our own gross NPA performance or portfolio behavior, it's been very good, and we started the year at 1.4% last year, and we ended at about 1.2% gross NPA. So our NPA performance, our portfolio quality has been very good. Our ability to manage the portfolio that we have exhibited in the past few years has been very comfortable, and the market demand continues to be very large. So if you kind of multiply these factors in terms of demand and our capability and our very comfortable levels of NPA, the growth rate should be good continuing going forward. Whether it is north of 35% or whatever, that is something that we will come out with in course of time. But definitely the opportunity to grow definitely exists.
I don't think the argument is there with the opportunity to grow, Mr. Vasudevan. I think everybody is convinced because of the sector that you address and the markets that you address, the businesses that you address, that there is potential for growth. The concern comes in at the point of the profile of the lenders that you are giving out money to, and whether or not that would have impact on your. So your NPAs are stable right now, but would that have an impact given the cyclical nature of the market that you address in terms of recoveries, in terms of non-performing assets? I mean, is that risk high, and are you working towards containing it in the future? And if so, how?
Yes, say the segments we operate in, as I mentioned earlier, is from the informal economy segment, in typically the cash segment of the market. The businesses that our kind of customers are involved in are those businesses which are very small and tiny. Their loan requirements are also small and tiny, anywhere in the microfinance about 15,000-20,000 rupees. In SME it is about 1.5 lakh rupees, and in used commercial vehicle it's around 3.5 lakh rupees. So the need for money is also very small, the kind of business they do is also very small, and because of the smallness of the small size of the nature of the business, naturally the customers are always exposed to a certain level of risk in their own businesses, and that would obviously put certain level of risk on our portfolio also. But the way to mitigate that, the way we have been mitigating that risk so far, has been in terms of a very strong reach to the customers, a very strong relation and rapport with the customers. We do a significant amount of investment of our time in terms of the cash flow analysis of the customer before we give the loans. We spend more than 3 days with each of our customers and we do a complete cash flow analysis before we determine what is the capacity of the customer to repay, and then based on that we set the loan limit. So the NPA performance and the NPA portfolio management really starts much earlier in terms of your the time when you give the loan itself. And if you do the appraisal properly and you do the cash flow analysis properly, then you're halfway over the bridge. And then the remaining halfway of the bridge, basically in terms of your portfolio and receivable management, is significantly supported by the relationship and reach that you have with your customers. The closer you are with your customer, the better will be the performance of the portfolio. And as we seek to convert into a small finance bank after we get the final license from RBI, we hope that the depth of the relation with our customer should actually go up more than what it is currently as an NBFC. And that strong relation is what we should be banking on to manage the portfolio quality as we go forward.
Will that lead to a decline and a substantial one in your return ratios? I think that is, you've answered the other risks quite well, Mr. Vasudevan, during your pre-IPO meets as well, the geographic concentration and a few others. What about the return ratios? The market, if there is one concern that the market believes, and universally so, is that your return ratios will come off over the course of the next 3 or 4 years. Will they come off meaningfully, or will you be able to maintain them, or surprisingly even better them?
See, there is a certain element of new cost which will get added to our balance sheet as we can transition to a bank. We'll have the capex in terms of our IT and branch infrastructure will incur. The entire liability cost of new teams and the rental cost of the infra that we'll be putting up the branches. We'll have certain level of negative carry on our reserve ratios of SLR and CRR. So there are certain new elements of cost which will come into our balance sheet. On one side. On the other side, we are going to have the benefit of a lower cost of funds. Currently, our cost of funds as an NBOC is between 12 and 12.5%. So the amount of interest cost that we can reduce as we transition to a bank, even if you are able to get it down to say about 9%, 9.5% to start with at the initial stage, there's going to be a lot of benefit that we'll get from a cost saving perspective on our interest cost. And there's certain level of growth which we should continue to have, and the benefit of scale in terms of reduced operating cost is another factor which will come on the positive side. So the net impact on our returns ratios and ROAs and ROEs is basically a function of how much expense hits us as we transition and how much saving we get because of the transition. Now how much we are able to balance these two will determine what will be the net impact on the balance sheet. And so far what we have shown clearly is management capability in terms of creating and running significantly large operations in segments which traditionally have been held to be risky, but we have managed to do it very well, and over the years we have established our capability to manage seemingly risky businesses in a very comfortable manner. So when we take that same capability forward, we'll have to assume, or we have to expect that we should be able to manage this challenge and the balance out the benefits in a manner that the return ratios should not be as severely impacted as what one might expect in any normal organizations.
All right, Mr. Vasudevan, just one final clarification that we would need from your end. And that is, as per regulations, the SFB has to get listed within 3 years of the holding company's listing on the bourses. I believe that the RBI has given assurance to SFBs that they would perhaps reconsider this, because once the SFB gets listed, then there are two entities. You have the holding company, which is Equitas Holdings listed now, and then the SFB comes on board as well, which gives a significant discount to the holding company. And that discrepancy in valuation would perhaps be not so good for investors. Have you heard anything from the RBI on this front? Because they have in principle communicated that they are going to reconsider the matter.
See, in our application to RBI for our in principle license itself, we had indicated that whenever the bank is required to be listed, we will seek an approval from RBI for reverse merging the bank with the holding company, because the holding company's only purpose of business or existence is to invest in the subsidiaries, and the subsidiaries are being merged to form one company, which will then become the banking company. So the holding company is going to have only one business of investment in the bank, which is its wholly owned subsidiary. So we have written in our application that we will seek to merge the bank with the holding company after taking due approval from RBI. And if you see, there is a certain clarification which RBI had set out long back on the SFB guidelines. So, if you read clarification number 101, they have indicated that after a 5-year lock-in period of the promoter, if a promoter wants to exit a small finance bank, then based on the regulatory comfort, RBI would consider the same. So in our case, we will have to seek approval from RBI at the appropriate time for reverse merger, and hopefully RBI may consider our application based on the comfort that they may have on us as an entity at that point in time.
Great, Mr. Vasudevan, congratulations on a good listing. Sorry, you were saying.
Thank you.
Great, Mr.
Yeah,
Vasudevan.
we have highlighted all this in the prospectus under our risk chapters.
Yes, of course. And I'm sure people have taken note of that. Mr. Vasudevan, congratulations on a great listing. All the best for the times ahead.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.